So what I'd like to do today is talk to you about this dilemma that the Federal Reserve is in. Because I believe that what is causing the volatility in financial markets, what is behind the third sort of year-to-date, end of the third quarter, dismal results for domestic stock markets, for emerging markets, for global stock markets, really even the bond market hasn't been doing very well. Pretty much across the board, we've seen a pretty unpleasant, right? It's been an unpleasant year for capital markets. And for those of you particularly who have projects that are far out on the yield curve, when you're out there in the most high-risk spots, you're seeing that pull back pretty quickly and aggressively. And you're thinking to yourself, okay, what is going on? Well, I do believe it's related to this remarkable uncertainty that has been introduced into markets around when is the Federal Reserve going to move. Because again, like I said, we were cruising into that September meeting all through the summer, and the Fed was right on track to raise rates, even by a little bit. Not going to be a problem, very well telegraphed, markets were expecting it, and then all of a sudden, they don't move. And we're going, will they? When? How much? Well, I'll get to the sort of point. I don't think it's going to be by very much. When the Fed does raise rates, it's going to be by just a little bit, and it will probably be sometime before the end of the year, probably at their last meeting. Because what the Federal Reserve is having to deal with are two opposing forces right now. What capital markets and any capital market participant is struggling with right now are two competing stories and narratives. On the one side is the slowdown caused by the Chinese economy globally. We're going to talk about that and the implications for that and what their crisis means. Try to get a handle on that. So that's on sort of the negative side of the scales. But then at the same time, if you look at what's going on with the U.S. consumer and what's going on in the U.S. economy, and people sort of forget, we've sort of discounted the U.S. consumer over the last few years, but we need to remember that it really truly is that U.S. consumer that is the driver of growth, ultimately. And what's going on with the U.S. consumer, all the forces are stacking up for the U.S. consumer to be the most positive environment that they have experienced in over 10 years. And the reason the Federal Reserve has been allowed to bring quantitative easing to a close, the reason the Federal Reserve was talking about raising rates at all is because the U.S. economy appears to be fundamentally back on very solid ground. And that solid ground is related to the strength of the position of the U.S. consumer. Now, what is behind the strength of the U.S. consumer? Because we know that consumer confidence is back to levels that we haven't seen since before 2007. What is that? What's behind all that? Well, I think the first thing is the recovery in the housing market. Housing market statistics are back to what we would consider to be normal. You've got sales running at a 5 million annual rate. You've got inventories down to the point where there's in some markets actually shortages of houses. And so I can stand here and tell you that U.S. housing markets have fully recovered from the financial crisis. And here's the interesting thing. It's a year ahead of schedule. Overall, the first positive news for the U.S. consumer has been that the housing markets have finally recovered. People can move around to change jobs because their houses are no longer underwater. All those good things that happen are in place. Second thing that's making a difference for the U.S. consumer right now is the labor market. Do not overestimate the power of the pump in terms of consumer confidence. Remember I said the powerful thing that prevented a recession in the United States after the Asia crisis was that gas got cheap and Americans went on a consumer boom. So if you think about it, this time last year, we were all paying nearly $4 a gallon for gasoline, right? It's expensive. But gasoline, oil and gas fall dramatically in response to a Chinese slowdown. And that's what's driving it. It's the Chinese slowdown. They're the marginal buyer for commodities worldwide. So if you are in any market or industry that is related to commodities, you've probably been feeling it for well over a year now. It started out in agriculture. It moved over into copper. Anything industrial has been suffering for over a year because the Chinese have been the swing buyer for so long, ever since 2000. They've been growing pretty consistently since they entered the World Trade Organization in '99, and now suddenly they're facing their first significant decline. The most interesting question right now is, how will the U.S. consumer spend their windfall? How are they going to spend it? 10 years ago, if someone got a $1,500 windfall, how would they have spent that money 10 years ago? They would have spent it on their house. They would have redone the bathroom. They would have bought a new refrigerator, Sub-Zero. That's how, because everybody was pouring all their additional income into their house. I don't know that that's what they're going to do this time around. I don't think so. I don't think the money goes into the housing stock in the United States because of the experience of 2007, 2008, and 2009. People finally have woken up to the reality that your house doesn't just go up in value. And that's a healthy way for people to approach their saving and investment decisions. They have to understand fully the risk of their decisions. Does it go into travel? Does it go into hotels? What does it go into? I don't know the answer to that question, and the stock market doesn't know either. So, strong dollar has been the story this year. Stock market's great at identifying who's going to lose from a strong dollar. Caterpillar, any company that's got large earnings outside the United States, any company that is connected intimately to the commodities business, boom, they're the losers, their stock decline. So that's what we're living through, stock market identifying who the losers are going to be. It takes a lot longer to figure out who the winners are. That's going to be the story of the next 12 months. What sectors, what companies benefit from an environment where rates go up, but they go up very, very slowly. The Federal Reserve is going to move at a snail's pace. They may even choose to raise rates in 10 basis point increments. We're all accustomed to 25 basis points every single meeting. Every single time. If they raise rates in a 10 basis points increment, it's going to take them over a year to get to a Fed funds rate of over 1%. It's going to take a long time. It's a really slow adjustment process right now. That's the environment that we're living in. Stronger dollar, and it's permanent. This is not a slowdown. It's not temporary. It's permanent. Federal Reserve raising rates incrementally. And finally, inexpensive commodities. And again, because I believe the Chinese slowdown is deeper and longer than what many people are thinking it's going to be, that means the outlook for commodities, it's not just a 1 or 2 or 3 year cycle. It could easily turn out to be more like 5 or 6. Long-term downturn for commodities.